that form, and some of the conversation we'll have today will identify tips and traps as they show up in that form. That's Form 3508. Last Friday, the SBA issued some additional final rules on, or interim final rules on the form and how you ought to approach it. Not a lot of surprise in there. We will, again, today be looking at some of those points raised in the interim final rule. Keep in mind, as you're submitting and preparing this form, this is going to go back to the lender from whom you took the PPP loan, if you've, assuming most on the call, received one. Of course, there's, I think Dave and I were checking earlier this week, maybe $120 billion left available for those who haven't applied yet. And the program, as it stands at the moment, is set to have those funds available through the end of June, to the extent that there's not a run on them this last month. So for those out there, this will apply eventually, depending on where you are in your covered period. But in the end, the program is certainly set to close by October 31st. The idea being that you will be submitting this forgiveness application within 60 days of the end of your covered period. At the moment, that covered period for everybody should be an 8-week period. We'll talk a bit about where that possibly extends or is amended here with some pending legislation in Congress. But you will be submitting your application within the 60-day period following that covered period back to your lender. We can go to the next slide, Dave. This is simply to point out the components of that application. It's an 11-page document, Form 3508. Schedule A worksheet rolls up to Schedule A, which then, of course, rolls into the calculation form that's on the top of the document. And then you've got this borrower demographic piece at the very end, similar to maybe borrower demographic forms you've submitted or filled out in, with other loans you've taken for your business. That's the optional portion. The loan forgiveness calculation is likely to be relatively straightforward for any borrower who does not land in some of the situations we're going to mention here today. But Schedule A and Schedule A worksheet are definitely comprehensive, in depth, and a bit challenging in terms of the calculations they require and present. For all of these components, you're going to have to retain, maintain, pull together a lot of documentation showing your employees from 2019, showing your employees from 2020 to date, and then ultimately calculating and showing for your covered period payroll expenses and the non-payroll expenses, all of which are addressed in the PPP legislation, and which we'll discuss here a bit more. But it is going to require considerable documentation, both to be submitted behind the application and with ultimately you retaining that for a period of time. So the advice, again, in general, the takeaway is start filling out the application now. Perhaps you have a payroll provider that, you know, if it's ADP or Paycheck, somebody like that, likely they have the couple years of payroll data that you're going to need to have at the ready to submit together with this and to retain. Dave, I'll send it back to you.
Yeah, thanks, John. So one of the, and I see we're getting a question that comes in right now. I think if I see a question, and I think we'll get it addressed in coming slides, we may pause to address some questions along the way, but keep the questions coming in and we'll try to address them all. One of the things that the application instructions and the recent regulation did was it clarified a concern regarding some language in the statute that talked about expenses, eligible expenses being paid and incurred. And essentially what it did was the SBA clarified that I'll say on the front end, costs that are paid during the covered period, even if they were incurred prior to the covered period, are includable and eligible costs, both for usage and forgiveness. So what that was really helpful in clarifying was, let's say you got your PPP loan on a Wednesday, and your normal payroll period was that next Friday. The question was whether or not the payroll costs attributable to that payroll would include just Wednesday through Friday, or whether it would include the entire payroll that you paid on that Friday. And they've made that clear now that it is the entire payroll. So in essence, it's going to cover more than the 8 weeks of eligible expenses. Now, on the back end of this, and this is the second point here, if there are costs that are incurred during the covered period and paid after the covered period, it is includable if it's made on the regular scheduled date. Now, so if the end of your PPP period is, say, on a Wednesday, and your normal payroll would be on that Friday, what they're saying is you can include the portion of that payroll up through that Wednesday, so long as you pay it on the Friday. So this was helpful because we were thinking that we might have to advise clients to do a short payroll period on the very last day of their covered period, their 8 weeks. And that's not necessary at this point. The same holds true as well for, lease payments. So if you got your loan on a Wednesday and your normal lease payment would have been on a Friday, you can include that entire lease payment as an eligible expense. The next thing that they offered, and this was new, was if you are a borrower that has a bi-weekly or more frequent payroll. Now, so this is not, once a month or twice a month. It has to be bi-weekly or more frequent. You can, for payroll purposes, elect this alternative payroll covered period that basically starts your 8 weeks relative only to payroll on the first day of your next payroll period. So in that hypothetical where you had the loan on a Wednesday, your payroll was paid on a Friday, and let's say maybe your next payroll started that next Saturday or Sunday, you can elect in the forgiveness application to use the start of your 8 week for payroll only purposes. This is not for other eligible expenses on that first payroll. Basically, what it's going to require is if you are a biweekly or more frequent payroll company, you're going to want to run it both ways and see which way lands better. And so work your way through that application and run those scenarios. All right, so probably the most confusing thing for folks is how we deal with FTEs. So the first question was, we knew that there's going to be some testing based upon, how many full-time employees did you maintain and or rehire during your covered period or leading up to getting the loan. First and foremost, SBA has landed on a 40-hour work week basis for determining FTEs. They discussed in the regulation that they considered 30 hours and other potential numbers. They landed on 40 hours. So that's the number we work on. They did offer 2 different methods for calculating FTEs. One is based on a tenths, round to the nearest tenth, or you could simply use a 0.5 increment. So for example, if you have somebody that's working 10 hours a week, you would round them up to a 0.3 if you use the tenths method. Or if you want to use the 0.5 or 1 method, that person would be a 0.5. No, you need to be consistent. Both, you use one or the other. You don't get to flip back and forth to get the most favorable math equation. But there again, kind of like that alternative payroll, I think it's going to be important for you to kind of run both scenarios. Now, the 0.5, and I've had this come up with clients this week, is also intended to be used for folks that, maybe you have employees that are sales based or on commission based, and you're not really managing their hours, and so using the 1.0, 0.5 methodology is a way to kind of simplify the calculation. And I should note that you do not get to count anybody more than a 1.0. So if they're working, 60 hours a week, they don't count as a 1.5. They count as a 1.0 in terms of the calculation. So, the FTE really comes into play if you've had reductions. And then there's this ability to restore, or the safe harbor. So the safe harbor says that if you had a reduction in FTEs between February 15th and April 26th, then you can restore full forgiveness if you rehire those employees on or before June 30th, regardless of the end of your 8-week period, incidentally. This is creating some confusion. We expect to see some more FAQs on this. So for example, if the end of your 8 weeks, if you were one of the first people to get a loan or first businesses to get a loan, your 8 weeks is going to end next week, likely. That's a lot of businesses. And so the question, for example, which we don't really have the answer to, is, well, let's say I had a reduction within that window and I restore, I bring the people back on, let's say, June 4th. I've got all my application done. I submit my application on June 5th or even, June 10th. And then later I do some FTE reductions later in the month before June 30th. Do I still get the safe harbor? It's unclear. There's some mixed messages in there. In fact, even in the forgiveness application, there's a line that says your FTE is as of June 30th. Well, what if you submit the application on June 10th? So we don't know about that. We'll talk a little bit later about some pending legislation, but there are definitely some holes and some gaps in this. The other gap as part of this is they talk about if you have a reduction within the covered period, which is not necessarily this window. Of course, it's not this window of February 15th to April 26th. So for example, if you had reductions in May, the way we read it is you are not eligible for the safe harbor restoration. So I don't think that's the intent. I think these things will get fixed, but that's where we stand right now. Last point here, and John is going to get into the other potential reduction in forgiveness, which is based on wage reduction. SBA made it clear that if you had an FTE reduction, you don't also get nailed for wage reduction. It's just FTE. So in other words, they're not going to double penalize you on that. So with that, I think, John, I'll flip it back to you.
Dave, before we go on,
yeah.
Relative to the FTE restoration, does it have to be the same employees or is it to the same FTE level?
Same FTE level, not same employees. But there is a little bit of potentially. So, what we'll get into here, for example, is if you had a reduction. I'm jumping ahead in the slides a little bit and maybe stealing a little bit of John's thunder, but if you have a reduction and you offer to rehire that same person and they decline, you actually still get to count them. You don't get penalized for that person if you have proper documentation. So yeah, to answer your question, John, doesn't have to be same person for FTE calc necessarily, but if you want to prove offer to rehire, refusal to come back, then obviously that would have to be the same person.
Okay. And I bring that up. It's a decent transition into maybe the biggest distinction between the FTE restoration and then the safe harbor that's in the guidance relative to wage reduction. Most of the folks that we've had extended discussions with on PPP and how to navigate the issues have been in that first category where they've been constructively shut down because of executive orders and been waiting for some sort of relief to get their business back open, bring the FTEs back, and optimize forgiveness as they bring those in. There's already a question in the chat room about a YMCA in a similar situation, the gyms and fitness centers across the state. We haven't spoken with as many who have had their employees subject to a wage reduction, but there is a safe harbor in the guidance and in the law for any that did reduce employee salaries and there's an important distinction here, for any employee who in 2019, in all pay periods in 2019, was paid an average annual salary of less than $100,000. Those employees are in a pool that if during the period of February 15th through April 26th of this year have had their wages reduced in excess of 25%. So you're permitted a wage reduction to your employee base of that 25%. Anything beyond that puts you potentially into a category where you will have dollar for dollar reduction in your forgiveness dollars. As Dave mentioned, they don't double dip. They look first at the wage reduction forgiveness issue and then go on an FTE analysis. But different than FTE, this is based on an employee by employee basis. The detail and documentation that has to be maintained by a borrower, you have to maintain records of every employee that you paid during the PPP period, the wages that they were paid, compare those wages to the average wage that they earned on or before February 15th, 2020. And we can skip, Dave, to the next slide here. Schedule A and the worksheet to Schedule A are going to be where there's clear calculations and analysis to any borrower in terms of how those documents come together. The safe harbor is to the extent that those wages were reduced by more than 25%. If by June 30, you restore wages, so any time prior to June 30, restore wages back to the level that that employee who earned less than $100,000 during the reference period of 2019 or first quarter 2020 is back to their wages, then you are potentially in the safe harbor. I say potentially only because to the extent you don't do that for every single employee, and that is at an employee level, not an average, but employee by employee, then that potential employee that's not restored to that wage level is ultimately has those wages, and it's the wages beyond 75% of their base pay. So if they were earning $100 per day and you reduce them to $60 per day, the difference of the $15, 60 to 75 are the wages that get reduced off dollar for dollar off of your forgiveness. If you reduce them only down to $75 a day, you're not triggering this issue and you're not having to seek the safe harbor. I think we can jump, Dave, into the next slide. I'll just say in closing on that wage reduction FTE, there had been an open question about wage reductions for any employees who'd earned over $100,000 at any time in 2019 and what that meant for them if they were reduced during this period of time, the covered period. They just don't simply land in the pool. The worksheet has table 1 and table 2. Table 1 is for any employee, all employees who earned less than that $100,000 during 2019, and they are the ones that would subject you to the need to seek the safe harbor. Anyone earning over $100,000 that might be reduced during this period of time does not need to be reported or restored to avoid or to seek that safe harbor. And that's where I'm referencing worksheet A, and you'll see that in table 1, table 2, and the detail in which you need to maintain wage information for any employees. Lots of questions have popped up relative to owner's compensation, at the outset, and again as this forgiveness issue comes forward now. Where I think the simple way to come at it is to understand that relative to owners either who have self-employment wages from 2019 or had payroll wages in 2019, they're capped at 8/52 of their annualized pay across all entities, not just for any single entity, but that $15,385 would be the absolute cap that any owner could be paid from one or multiple entities during the PPP period. Questions arise more often than not in a situation where there's an owner who may not be an owner employee or who may not have payroll expenses to which we could refer in 2019. In other words, they took only distributions in terms of how they were paid from the business. Some folks in an S corp might have a salary set up at $50,000 and then as an owner get a distribution at the end of 2019 of $100,000 for any profits or wages. Only the $50,000 becomes the 8/52 that gets calculated. So that owner could be eligible for up to $7,690 in payroll expenses and no more than that during the covered period. And there'd been some thought about, okay, could we increase that owner to $15,385? The answer is no. The open issues that are out there are, well, what about that owner's spouse or other family who might be coming in for performing work during the period? if there's cleaning or some sort of, whatever related to the business, they potentially could be paid that $15,385. Similarly, there's bonus potential for any employee who's not earning in excess of $100,000 to be maxed up to that $15,385 during the PPP period. Dave, I welcome if you have other comments on this. I know this is something that comes up a lot.
Yeah, I had a number of clients that obviously took this strategy early on to just to say, hey, I'm going to raise my pay. I've had clients that have multiple businesses that said, or actually implemented a strategy to, I'm going to start taking pay out of these companies. And I'm not saying that they had nefarious intent. In fact, they would say, look, I'm doing a heck of a lot more work for this company than I ever have, and I've never taken a payroll. Unfortunate for them, if they are the owner of that company, they use the money and they're not going to get forgiveness on it. So it's not an ineligible expense. You're not going to get in trouble for doing it. It just means you're not going to get forgiveness on it. So you're going to end up with a loan.
Thanks. Maybe one other piece there, because there is the self-employed owner that just the term under PPP for that owner is owner compensation replacement. Your tax return probably from 19 showed that you were paid only on net profits of the business, and you would be limited 8/52 of the net profits from 2019 for purposes of the PPP. And
sorry, John. That's a great point to bring up, because we're getting a ton of questions on that. And this kind of leads into these non-payroll costs, which is, unfortunately for self-employed, the non-payroll costs end up being somewhat irrelevant for forgiveness purposes, but I'll let you jump into that.
Well, and I think that's as much the case because these things are capped at 25% of, or they may not even have them, but there were payments on any business mortgage obligation, so long as it's real or personal property. There was a question early on here about that, to the extent that interest has been incurred on machines or other equipment, personal property during this period of time, so long as you can show evidence that you actually incurred that obligation prior to February 15, 2020, you should be in the clear relative to that covered obligation and the interest that you've had to pay during this period of time. Interestingly, you cannot advance pay any. It is absolutely clear in the interim final rule that a person is not paid and incurred interest during the covered period on any interest that might be accruing or coming due in, say, any period after the covered period. I raise that because, as to the next slide, you can move on, Dave, non-payroll costs. In addition to the mortgage obligations and the interest that's eligible for some forgiveness, we have other non-payroll costs, including rent obligations for lease agreements. Again, having evidence of those leases being in place on any copiers, vehicles, equipment prior to February 15, 2020. And similarly, you've got utility payments. I think we've had questions about folks who've added telephone or internet services for employees after February 15. Again, it's important that we can document, with all the documentation will be required here, that those obligations existed prior to February 15, 2020. Compared to the mortgage interest obligations, these covered rent obligations, covered utility payments, there is not the same distinction in the interim final rule. In fact, it's just left silent as to whether prepayment of these costs, non-payroll costs for rent and utilities, are forgivable if you were to advance any of them, let's say because of some deferment arrangement with the landlord or some other agreement with a utility service provider that could say, I need to pay these now. I'm anticipating some cash crunch here or there down the road. Not absolute guidance on that, but the question is open as to whether, if you're looking for some way to bump up to you have a 25% cap on these non-payroll costs, there may be some flexibility to pursue a strategy related to those rent or utility payments and how those get paid going forward.
One thing on that, John, cell phones, still not clear guidance. I've had people, it says telephone, I suppose in 2020, telephone arguably means cell phone, but
Right.
they haven't said that. So maybe
I
look
think we've
to
talked,
FAQs about that.
there's that allowance piece too, Dave, on transportation. There's been some things popping up. Maybe this is a place to mention it, just on transportation allowances or fuel allowances, bus passes. Let's say you had employees who were using some sort of public transportation and now are having to incur costs to get to work on their own. I don't,
Right.
does that actually qualify
Well,
here?
yeah. John, we've been talking about the 25%, 75% rule. Just worth mentioning real quick here again. So the rule as of today, and we'll probably end with a slightly different prediction. But the rule as of today is that you do have to spend 75% of the PPP funds on payroll costs to qualify for full loan forgiveness. If you're below that threshold, if you're 60/40, you basically just get, reduced on a simple fractional basis. And as I say here, stay tuned for pending legislation. Let's talk about these usage ideas. I think John was alluding to it a little bit on the allowances here, but one of the things that the interim rule came out and actually said for the first time was hazard pay. Use that word. Leading up to it, I've heard it a lot from clients. I've cringed a little bit at the the description of it for some employment law purposes, but they use it. And so absolutely fair game. So if you're coming up to the end of your 8 weeks and you've got money left, how can you maximize the usage and, and at the same time maximizing the forgiveness? So here are some ideas. Hazard pay bonuses, those folks that are going above and beyond, bonusing them. Great idea. You see here, hire more people to clean, perform maintenance, restaurants, bars. Right now, I mean, you're closed, but can you get ready? Obviously we've got this June 1 date coming up with the outdoor potential dining options and whatnot. Yet to be seen how long that's going to go and, when indoors are going to open up. But in the meantime, can you put people on payroll to do these things or bring people back in to do some of these things for your benefit? Allowances within. Now, this is not expense reimbursements. Those would not be considered payroll, but, for example, a car allowance, maybe to keep people off the bus, or maybe a better one, one of the FAQs actually talked about a housing stipend as being part of payroll costs. So, get creative. Is it a cell phone allowance, whatever it is, but just making sure that that allowance runs through payroll and is paid within the 8 weeks, I should say. This is important. We talked about paid and incurred relative to rent. If you have been getting deferred rent, consider paying that during the 8 week period. Of course, you got to look at your 75/25 right now. Next one, we talk about paying out accrued vacation. So if you have accrued vacation, that's happening during the 8 week period, consider buying that out. That'll, help you down the road, and it is a payroll cost. Or if you have people that are paid on a basis of commission or bonus structure, and it's a quarterly bonus structure, if it's incurred during the 8 week period, accelerate and pay it out during the 8 week period. Just a few ideas, some things that we've gathered up as we're walking through this with you.
A point of clarification there, Dave.
Yeah.
We've had this conversation a bit. Is paid and incurred. So earlier we talked about the regular payroll period, and so long as that is paid at the time that would usually be paid, whether it's a utility payment or payroll payment. But for non-payroll expenses, they have to be paid during the 8 week period.
No, let's clarify that. So
Yep.
if your rent is on the 1st, let's say, and the end of your 8 weeks is on the and let's say, well, no, rent's not a good one. Utilities is a good one. You pay utilities in arrears, right? You pay it, you use it, and then you pay it after you used it. Rent is obviously usually in advance, but utilities, let's say you normally pay those on the 1st of the month, and your 8 weeks ends on the 15th of the month. You don't have to accelerate and ask the utility company to give you a bill that you can pay on the 15th. You can pay it on the normal payment date following the end of your 8-week period. But you only will get to deduct the amount that was incurred during your 8 weeks. So again, the incurred piece on the front end of your 8 weeks, if it was incurred prior to the beginning of your 8 weeks and you paid in the 8 weeks, absolutely can use all that. On the back end of it, the incurred ends at the end of the 8 weeks. You don't get to accelerate or prepay rent, that happens after your 8 weeks.
And so to the extent anyone's planning to do any hazard pay or bonuses to employees, that has to show as paid during the covered period.
Correct. So it's whatever would be incurred. The issue there is if your normal pay, if you pay those out just as a bonus at the end of a quarter, that's not a normal payroll, for example. So that's just one of the ideas there.
Yep. Thanks.
Yeah. Back
to
couple
you, slides here, just an interpretation or heads up relative to the certifications and documentation. Be prepared absolutely to sign and commit whoever the authorized representative is for borrower that you're potentially availing yourself to criminal charges, civil penalties. If what is all submitted in the forgiveness app is not verifiable, not accurate, you are indicating to them that the dollars used were only used in furtherance of eligible payroll, non-payroll costs in the program. You're also indicating, I think, that SBA can come and evaluate the documents, records that you might have relied on in addition to what's submitted with the application, and the basic certification that you've included all the right reductions, safe harbor information, and you're not including more than 8 weeks for any compensation for any owner, et cetera. So lots of certifications. They mirror largely the certifications that you signed if you were the authorized representative at the time you made the loan application, but those certifications are going to be mirrored here. We can go to the next slide. If we were to take the list of all the documentation that's actually in the forgiveness application, it fills out about an entire page, anywhere from having bank account statements, receipts, canceled checks, all kinds of documentation showing FTEs from 2019, FTEs first quarter 2020 I mentioned, and then records for those non-payroll costs verifying that they existed prior to February 15th, and then records of payments actually made. We did speak about those periods. Obviously, you want to have records that the payments were made during the covered period or the alternative covered period, depending on which you're using. The biggest advice here is be prepared to keep this in your files for 6 years after the date the loan's forgiven or repaid. And again, that's a lot of records to keep just in a big box for PPP purposes. Probably many of you were following along a few weeks ago when they indicated that those loans that were in excess of $2 million would all be subject to audit. That's not to say that anything less than $2 million won't be. It just won't automatically be. So please take steps to retain these records. We can go to the next slide. A number of questions have popped up just in the time we have here, and we're happy to take any specific related to this. But relative to the safe harbors that we talked about on FTE reduction or wage reduction, to the extent that, and this is going to, I think, be a real issue, obviously, the $600 of enhanced pandemic unemployment has been a reason for those businesses that have been constructively closed. Obviously, folks that could benefit or qualify for that additional $600 a week for unemployment potentially are doing as well or better than if they'd been at work, and that might be the salve that at least is meeting the wound right now. But in terms of you having to qualify for forgiveness, that becomes your problem, and I've seen some questions here. Obviously, documenting that you've attempted to rehire that person on the same terms, same hours, and that they have flatly rejected it is going to put you in a place where you can show that you're no longer, that you're working to meet the FTE safe harbor, and that employee or that FTE should not be counted against you. Similarly, guidance provides that during the covered period, if you've got folks fired for cause, who have voluntarily resigned or requested themselves, some kind of reduction in hours, that is not going to cut against the employee or the borrower for forgiveness purposes. So we're advising here to maintain that any text messages that have been exchanged, voicemails exchanged, but ideally these things, the offer from employer to the employee needs to be in writing. We've helped folks with that form the last few weeks, and imagine that, you know, for those businesses that have been closed, if there's not some kind of amendment to the program right here, and you're really looking to optimize PPP forgiveness, you may be in a spot where you're needing to extend those offers to bring people back and meet those safe harbors by June 30. The step is outlined here for you on how we go about that. Dave, you're muted.
Sorry, trying to manage multiple machines here at the same time and answer questions in the chat room. I'm a little bit out of my my strong suit. One thing on the documenting rehires, they also added this requirement that, and I think you mentioned this, you do notify the state unemployment office. I think that's their attempt to try to dissuade people from staying on the enhanced unemployment. I did read this morning, as we're trying to stay on top of what the pending legislation is that some senators, Republican senators, are talking about, scaling that back, and maybe that goes to, from 600 to 450. But I think everybody, bipartisan basis, recognize that the enhanced unemployment benefits have created this unintended consequence where folks may not want to come back to work. But just stay tuned on that as well. That leads me to what if the loan is not forgiven? Okay, so if you don't get full forgiveness, right now the SBA has said that the maximum loan term could be, would be 2 years, and it would bear interest at 1%. And the first 6 months would be deferred. It's kind of an interesting practical consideration that, let's say that you didn't get your patient until the end of your 60 days, and the bank took the full time that it had to get it into SBA, and SBA took the full time. I mean, it's theoretical that you could be past that 6-month deferral, and what do you do in the interim? I think what we're, part of this is, theoretically, if you didn't get full forgiveness, you probably didn't use all the money. So what you should be able to do, and this is the no prepayment penalties or fees, is just pay it back to the bank. Now, one of the things we've heard, and this is a little bit of a misconception out there, is that if you do not get forgiveness, then you've got this money and you can just use it for whatever you want. That is not true. The same rules apply to the PPP program, whether you get forgiveness or don't, that you can only use it for these eligible expenses. So if you want to take on the loan to pay for payroll and other eligible expenses, that's your decision. But you don't get to use it and then pay a dividend to shareholders, or buy a bunch of equipment, or do things like that. Now, obviously, money's fungible, and if it's commingling with your other funds, I mean, there's a tracing issue there. But we have seen that certainly kind of goes along with that certification that you made at the outset of this, that you're going to use these funds for those eligible expenses. That is not lifted if you don't get forgiveness. And John, I don't know if you wanted to make a comment about that.
Oh, the only thing I'd add to that, and I think in talking through that primarily only becomes problematic for the business that is unable to reopen or may not be reopening, and there are these funds that are still out there and not eligible for forgiveness. In all likelihood, if you're opening even at a 50% or 25% level, you're still going to have payroll expenses for the balance of the year that are going to exhaust the remainder of PPP funds that maybe aren't forgiven because they weren't expended during the covered period. But it's those businesses that potentially don't reopen that have borrowed are likely best to consider the possibility of turning that money back at the end after they've calculated the forgiveness.
Right. There's a couple questions coming in the chat room. I just say hold tight. We got one more slide, and then we're going to get the questions, and I think we can start addressing this. So here, pending legislation. So right now, I think the vote is likely going to happen today in the House on a House bill that is. I think it's called the Paycheck Protection Flexibility Act or something along those lines. But here are the key points to it. They would extend the covered period from 8 weeks to 24 weeks. There is a similar bill in the Senate that would take it from 8 weeks to 16 weeks. So, we told you all these rules, and now we're telling you that it's likely that the 8 weeks is going to get extended. If I had to place my bet, that's what I would bet on. The other things that the House bill does is it gives employers till the end of the year to hire workers back or relaxes those rehiring requirements, and it eliminates the 75% rule. I've heard one banker basically describe this as if they adopt this law, basically if you have a pulse, you're going to get forgiveness. So now as lawyers, here we're teaching you about what the law is today, and we're telling you the law is likely to change. The biggest issue for all of us in this is, we've got PPP 8-week periods coming up towards the end. So, for example, I'm seeing a number of questions in the chat room about, how do I take advantage of that PTO acceleration and pay? I've got a normal 401k match that happens at the end of the year. What do I do with that? These are tough decisions. If you're coming up towards the end, you're going to have to, what I'll say, place a bet. And your bet's going to be on whether or not you think the 8 weeks gets extended, because in which case, if it gets extended and you're using it for payroll, you just keep using it for payroll. You're probably going to end up using all of your loan and will get it forgiven. And certainly if the 75% rule gets eliminated and you're using it for rent and utilities and payroll and whatnot, if it goes to 16 weeks or 24 weeks. So all of these strategies, if you had deployed them, you might wish that you had not done that. And so I say that here, we're giving you these potential ideas, and now we're telling you, of course, wait on that. But, if you are coming up next week, this is a tough bet. You're going to have to decide, do I want to accelerate it right now? Now, maybe it ends up being a moot point because you still get some benefit. For example, if you buy out vacation pay, you're still getting the financial benefit of that down the road. If you accelerate a 401k match that you normally would do, you'll still get the benefit of that down the road. I would say this on the 401k match and the vacation buyout. If you have employees that are over 100,000, you got to be careful with that. Or if their total payroll in that 8 weeks would be over the 15,000 and change number, 385 number, then that's not a great strategy. So terribly
and
complicated.
There's a little bit careful what you wish for. If this thing gets extended, it fixes some problems, maybe makes new problems with what becomes of the June 30 dates, those reference dates. Do they get kicked down the road? And now for anyone that's been maybe waiting on some furloughing decisions or employee reduction decisions, are you a little bit further out from that? Perhaps you've got more flexibility. I'll say, just to follow on Dave's point about the PTO, we're hearing that question probably a few times a day right now as folks are imagining, all right, I get my business back open and nobody's taken any PTO the first half of 2020, and now I'm going to get to the end of the year when I need to really push things through on the line, and folks have a bunch of pent-up PTO. Look to the written policy you've got on that. You may be able to amend that midstream or buy out the PTO as we're recommending. We have an HR specialist, a partner, Greg Griffiths, who certainly can review that too, and has looked at a number of those things for folks. But that strategy seems to really be one that people are looking at and using as they imagine getting to the end of this period.
Yeah, so that leads us to our last slide here, which just says questions. And I show you our emails here. I know I think I see a few. I may have gotten one or two questions that were posted just to me. Unfortunately, I'm trying to manage multiple machines, and the ones that are coming to me are coming on my phone, and I can't really type. So happy to take some of these questions offline. Happy to answer your questions, via email to the best we can. So please take advantage of that. I see that we got a question. Are you going to get a copy of the PowerPoint? Yes. We'll send that to Christy and Amanda, and they can then circulate it to the chamber, as well as recording. I do have to apologize. I forgot to start the recording until about 3 minutes in, so it'll have a bizarre beginning, but I think all the substantive stuff is in there. So Christy, you may want to reconsider if we do another one of these, who's running the slide deck. But I don't know, Christy, do you want to jump in here? I've got, here's one question. Being self-insured, are we to use COBRA amounts to determine health insurance premiums? What do you think about that, John?
I haven't seen it. I think if that's the only reference point, it makes sense to me, but I have not seen thoughts about the self-insured COBRA piece. Maybe we can get something and send that back.
I think on that one, it occurs to me that it's probably, you have to tie it back to some articulable cash amount that you've deployed. I'm not sure everything that they're coming out is a cash basis is what I'm saying. It's less of a accrual basis. That may not be your question, but we're not referencing it to recategorize, certain amount of payments in there based upon some reference points. So I think you have to tie it out to an actual cash payment of sorts. I know, let's see, I think we tried in the chat room to address many of the questions. If anybody else has a question, happy to kind of unmute you too, if it makes more sense. Just
yeah, I think we're at a point where if someone wants to ask a question, just go ahead and unmute yourself and ask away. Certainly, if they have questions, they can email us at the chamber, or we can try and do our best to help or get the answers from John and David as well. So know that we can gather those questions and answers for you.
Yeah.
The question was asked, can we get a copy of the PowerPoint? We will have this posted on our website. So the team at Dunlap and Seeger they're recording it. They will send us the recording and the slides themselves. So
I didn't mean to go to that. Give everybody a chance to ask a question.
So I'll ask a question.
Yeah, great.
I'm the one that posted asking about the COBRA amounts. So from what you had replied, would I look at using the claims that we paid over the 8-week period then as a number?
I guess I'd want to look again at the definition of payroll costs, because that's where it would be. I mean, if you're paying them specifically on behalf of somebody, I would think that you would, because that is a benefit that you are paying on behalf of an employee. Mm-hmm. John, do you see it the same way or differently maybe?
I'm hearing it the same way. I think,
yeah,
especially, and you have the same expenses 2019, same way, self-insured 2019.
Yes.
So I would say, here's how I would look at that. I would say not only is it what you paid, what was incurred and paid within that 8 week, but if you had a claim that was pending before the start of your
covered period,
the beginning of you getting the loan, and it naturally was going to be paid within that 8 weeks, I would include that as well. Okay. That's how I read it. If that's helpful, hopefully.
Okay, thank you.
Yeah, thanks for the question. Dave, I'll maybe just say in general, where a lot of and we've had this conversation a few times, the struggle has been between, folks looking for opportunities with some of the usage ideas for owners and those that are maybe capped at that 15,385 versus how to get the balance of funds out to employees and those who are under the 100,000 annualized. And it seems with the interim guidance, just that the SBA looked for opportunities to get this money from borrower into the hands of those employees. So to the extent that these questions are coming on PTO or the retirement plan contributions, things like that, to the benefit of the employees, yes, if it's an owner or someone that's maxing that 15,385, be careful.
Right. There is one other question that I got, and I may have given an insufficient answer in the chat room. The question relates to, are part-time employees included in the FTE calculation, and are they, is their payroll not forgivable? Well, two things there. Number one, full-time equivalent. So, if you don't have any 1.0 FTEs, that's fine. For purposes of the usage and forgiveness, you can just pay those people and it's fully usable and forgivable. The issue is if, let's say you have people that are normally working a 0.5, and because of the pandemic, you've reduced them down to a 0.2, okay? During these relevant periods, you could end up with a loan in the back end because your forgiveness gets reduced because of that. And then if you did it during that February 15th to April 26th window, you have the ability to restore them, say, back to a 0.5. But it even gets more complicated, because if that were the situation and you elect to calculate everything on the basis of 0.5 or 1.0, it may be irrelevant for the FTE. But it gets more complicated because of the wage reduction too. So sorry to be bouncing around a little bit. It does get very confusing very fast.
David, thank you for that. I'm the part-time employee question guy.
Oh, great.
So just so I understand, the part-time employees that I had were part-time last year. They're 0.5s, let's just say.
Yep.
So they are included. They are forgivable. I was under the impression if they weren't 1.0.
Nope, they are.
Okay.
So here's what you need to do, and let me back up and let's just go through the FTE thing one more time real quick.
Thank you.
So you're gonna have a baseline, which will be your denominator, and you can choose from one of two periods. And I know this wasn't in our slide deck; it was kind of in a previous slide deck, or previous presentation. But let's go through that. You're gonna have the denominator will either be your average FTEs during February 15th, 2019 to June 30th, 2019, or you can choose Jan 1 of 20 to Feb 29 of 20. Okay, so that is more or less your baseline. Okay, if you had reductions during your covered period, and that becomes your numerator, if that number is less than your denominator, you could end up with partial forgiveness or forgiveness reduction because of that. But as you're doing both of those calculations, you have to count in all part-time employees. So it's the 1.0 is the maximum anybody can be. So if they work more than the average of 40 hours a week, they can only be a 1.0. If they work less than that, then they are going to be, well, here, I think I got this question in the chat room. What if I have somebody that works a 36-hour work week? Okay, if they work a 36-hour work week, they are either going to be a 0.9, or as I read it, a 1.0. There is an argument to say that they're a 0.5, but I read it as you round up to a 1.0. But either way, you're going to have to be consistent on that in your calculation. And as you work through the, go ahead, John.
I was just going to say, but you made this point, but between counting them in the tenths or in the 0.5s, right?
Correct. But
across.
Correct. So if they're part-time employees, if you ended up reducing their hours or even just furloughing them, you're going to have to still count those in the page 9 table 1 analysis as part of the potential forgiveness reduction calculation. Did that answer your question? I know it gets confusing.
It did. Thank you.
Great. I see another question. Are union benefits includable in the forgivable amount regarding retirement and health insurance? I believe yes. Yes, they are if you're paying them. Let's see. I think that may kind of give people just one more minute and see any other questions or want to pop in. Oh, we got a couple more here. I had employees that worked up to 60 hours per week and now on 40. Is that going to affect my FTE? Should not, because they're a 1.0 in either situation, but the wage reduction could be interesting. But if they're wage reduced because of just hours, then I think the guidance is clear that should not.
Does the question really relate though to if the loan application was based on to include overtime pay from 2019 and that overtime's not been incurred in the covered period?
But I mean, that's a good point, but in terms of the FTE test, they're a 1.0 on either side. It won't matter. So, but on the wage reduction, I think you can rely on the fact if you only reduce their hours. Yeah, but it just says you can't get double nailed by it. You may end up getting some wage reduction. I'd have to work my way through that one.
Yeah.
Sorry for the not definitive answer on that. The FTE is very confusing when you have a lot of part-time staff. My calculation was done by hours worked by all employees, 5,000 divided by 40. Yeah, unfortunately, I think you're going to need to do it on a roster basis, a per employee basis. I don't think you can aggregate it. I mean, I suppose you can aggregate it all, but as you look at the table for the calculation, they have it set up so that it's a per employee kind of a thing. Is an employer? Go ahead, John.
I'd say yes, so long again as it's been paid and this is paid in the usual course. It's incurred.
You're talking about the question on the pension plan?
Yeah.
That's correct. Yeah, it's a retirement benefit. And I would say any of you folks that, maybe we didn't if there's more facts that could help us, better answer some of your questions, feel free to, again, take this offline, shoot John and me an email, and we'll do our best to try to get you an answer. We're getting new laws every day, and it's interesting. If you want to find the holes in your law, just go ahead and pass it, and then you'll find out real quick where all the gaps are, and that's what we're experiencing. So, as we're working through all these scenarios, we're happy to take it offline, like we said, and give you some better answers if we can.
Thanks again for the opportunity to the chamber, and hope you're all hanging in there and working through this.
Thank you so much, guys. We appreciate everything that you've done and keep your ability to keep bringing us relevant information. So thank you for doing this for our members. We appreciate it.
Yeah, thank you.
All right. Have a wonderful day, everyone.
You too.